Hey everyone, Meet Kevin here. We are back with another Meet Kevin show, and today we get to talk with the co-founder and CEO of LMND Insurance, which is a company I have been extremely excited about since before IPO, on IPO day, after IPO day. I've been jumping up and down about this company revolutionizing the future of insurance. And folks, I'm super excited to bring on Daniel. Welcome aboard, Daniel.
Great to be with you, Kevin. Thank you.
Thank you so much. So my first question, ARK Invest, they obviously are very popular in the investing space. They mentioned they don't love your reinsurance model, and it's one of the reasons they don't want to invest in LMND. Can you speak to why people would be fearful about reinsurance, and should they be, or is this actually really a good thing?
Wow. No, they should not be. They should not be. Reinsurance is something that we use in ways that I'll articulate in a second. But one thing to make clear at the outset, we don't actually need reinsurance. LMND, rather unusually in the tech insurance space, is a vertically integrated company. We are a fully licensed insurance carrier, as well as having our own captive agency and our own tech stack, both in the US and in Europe. So actually, we stand all the way down on our own two legs and are not beholden to traditional insurance carriers or even to reinsurers in order to conduct our business. So tapping into reinsurance is an option for us. It's something that we can do, and if terms aren't agreeable to us, we can also make do entirely without. We, as I say, are regulated in our own right. So why do we make that choice? Why do we take reinsurance as well? So for us, the primary reason is cost of capital. So the way reinsurance works, in the way that we have set it up, this is not always the case, is that it allows us to make every dollar that our investors give us go about 2 or 3 times further than if we had no reinsurance at all. So it's really about an arbitrage of how much capital costs us versus how much it costs large reinsurance carriers. And that's really what the game is about. It's about optimizing capital, and the terms are favorable now, so we do it. If the terms were less favorable, we wouldn't do it. That's really what it's about.
That's interesting, yeah, because that was one of the big things that they mentioned, is that they're worried that what if these costs change and then you're beholden to this? But you're actually saying we're not. Look, if it gets to the point where it makes more financial sense to carry all of the risk, we'll do it.
Totally. And as we get bigger and as we have larger and larger coffers, which we do, we've now got over $1 billion in our bank account. We'll keep reviewing that. That really is something that we review periodically. And the cost of reinsurance, it's a commodity, and the costs go up and down with supply and demand. And we were able to obtain contracts on terms that are incredibly favorable. If we can renew on those terms, great. And if we can't, we'll readjust accordingly. So it's something we can be pretty flexible about.
Got it. That's incredible. So the reinsurance, your model now is 75% to reinsurance, 25% that you keep. Do you have selection over which policies go where?
It doesn't quite work on a policy basis. Every dollar that comes in, split 75-25.
Darn.
Yeah. And every claim that gets paid is paid 75-25. So it's really a stream of capital that it all comes into LMND, then we divide it, give 75% to our reinsurers, and as the streams come back out to claims, it's paid out in that same proportion.
Got it. Okay. A big question that also comes up is, when are you going to be in every state so we could use you in every state?
We actually are in every state, just not for every product. Yeah. So,
okay. That's it. Okay.
Yeah. So the crazy thing about insurance in the United States is that there is no federal laws. It's all state by state.
Oh, gosh.
It couldn't be more awkward and cumbersome if you tried. If you designed it to be cumbersome, it would look like this. So we do have to go state by state by state for every product, and every state, the great state of whatever, doesn't just say, oh, everybody else has approved it, so we're going to approve it. They all have excellent people who are paid to review everything that we do, and it gets done 51 times, 50 states plus Washington, D.C. But we are available to the overwhelming majority of the customers in the United States for all of our products. So something like 80-90% of people in America can buy all of our products. The remaining can buy at least one product. Everybody can buy at least one.
I mean, I have to say, when you go to lemonade.com, it is the most pleasant insurance application process I've ever gone through, compared to just, I mean, anytime, for example, I work with a lot of rental properties, and I don't think you, at least as of like 6 months ago, you weren't doing rentals yet. Still not doing rentals, right?
Renters insurance?
Yeah, well, no, sorry, like landlord insurance.
No, you're right.
That when you bring that in, I cannot wait to run all of my properties through that, because the process is so simple. And I just love the system you've set up. It's so unique. I mean, nobody else is doing this. I think there are a few new competitors that have popped up. Are you allowed to say, or can we speculate on when landlord insurance might be in the iron sights?
So people who have a home of their own that they're renting out can buy homeowners insurance. We just don't do it at an kind of a commercial level at which you're operating. And of course, we have a lot of landlords who encourage their tenants to get Lemonade insurance, because as a landlord, you do care. You want to make sure that if they burn down your property, it's insured. So you do care about renters insurance for your tenants. But you are absolutely allowed to speculate about when landlord insurance will come in. Have at it.
Gotcha. Okay. I'm sure it's on the radar. So what about, everybody's asking about car insurance. And this has been mentioned in some of your earnings calls as well. I want to say the most recent one, the focus was on life insurance, term life insurance. Why prioritize term over car?
Yeah, it's a great question. And we're really beginning to see the flywheel that we've built gain momentum. So for the first few years, we're 5 years since we founded the company, less than 5 years since we launched our first product, which was homeowners, renters, condo, home. And for 4 years, that's all we had. It took us 4 years to get to our second product. But
right.
After that, in July, we launched pet insurance, which is going like a rocket ship. And then within 6 months already, we launched our second product. And then, there you go. Thank you. We launched life, and we said on our last earnings call that we've got a major launch coming. In fact, we've got more people working on this yet to be announced product than on life or pet or home. So there's a lot of effort going into our next product launch. And honestly, the prioritization or the sequencing isn't based on priority in terms of importance. We want to get to every product that our customers need. And it's hard for me to tell you whether they need car insurance more than life insurance, or pet insurance, home insurance. These are all high priority insurance products that really protect people and their loved ones from any disasters that could strike during lifetime. So it is important for us to cater to all of their needs. We do see car insurance as being one of those needs that people have. In fact, everything that we're doing in homeowners insurance today, we're kind of doing with one hand tied behind our back, because if you can't bundle car and home insurance, you're at a disadvantage, and you're kind of sending your customers over to your competitors who will readily offer them a competitive bundle. So we understand the pressure, and we're certainly taking that on board.
That's a very interesting, really catalyst that I haven't even thought of is for a change for the company is once you're able to bundle all of these things, you could essentially offer, and I'm speculating here, and I know there's certain things you can say and can't say, but in essence, a future vision would be, hey, click a button, here's term life, home, auto, whatever you need.
You're hitting the nail on the head. That's really what it is about. We are very customer centric and trying to understand his or her needs, and it hurts us that today some of those needs go unfulfilled, and it's a huge bug, right? It's like they don't have that button. The button isn't there yet, so that we're forcing them off to our competitors. And one of the amazing things that we've seen since launching pet and more recently life insurance is that it happens exactly the way you're saying. So we used to be a very linear kind of path. You'd join us as a renter, and then a few years later you buy a first condo, and then you graduate to your home. And that is stunning, because you see people graduate through those properties. The insurance needs jump 10x usually during those transitions. So you acquire them profitably here, suddenly they're paying you 10 times as much here. All is good. But what we're seeing now with pet and life is that there are now multiple on-ramps and cross-ramps. And suddenly people joined us with renters insurance, and then they add pet insurance, they 4x their premiums. If they add life insurance, they 6x their premiums. And we're seeing that about half of our sales of life and pet are happening that way. Zero cost of acquisition, because they're coming through existing customers who are then cross-selling products. And the percentages are growing fast. So our business almost doubled in 2020. But our business of graduates grew almost 300% during that same time. So we're seeing an acceleration of this dynamic that you're pointing to. Absolutely. It's a big deal for us. Big part of our strategy.
Can you say the average age of your customer?
Yeah, it's in the early 30s.
Okay, and that's was a little along my suspicion that potentially Lemonade's going to be very, very hot with millennials. I'm a millennial. I think it's awesome. But potentially concerned that maybe, the 50 to 70 crowd's going to be a little bit more into, I'm going to hit up my broker and I'm good kind of thing. Have you had any concerns about on-ramping maybe those customers who do want to speak with someone live as opposed to our chatbots?
No concerns, in as much as they're well catered for doing what they're doing. That's just fine. Mm-hmm. We're not trying to play the game that every insurance company in America plays, which is if you watch TV for more than 3 seconds, you'll be hit by a commercial the theme is I switched and I saved, right?
Yeah.
15%. I switched to Liberty Mutual and I saved 900 and something, whatever. You've seen the commercials.
I can't get those ads out of the Liberty. Oh my gosh. It honestly, it drives me nuts. Sorry, but yeah.
Exactly. So everybody's hitting the same messaging, which is switch and save. Mm-hmm. You've never seen that really from Lemonade seldom. That's really not a central plank of our messaging. We're acquiring customers before they go to another carrier. First-time buyers of insurance are about 90% of our customers. Only about 10% of customers are switchers. It's stunning. It's really amazing. And among people like yourself, Kevin, millennials, first-time buyers, people in their 20s, I think we may be the number one brand in America in terms of market share. Wow. It's certainly close. There's no good data on that, but the data that we have suggests that we may be the number one brand, having overtaken all the companies that have been around for 100 or 150 years. Now, if you think about that, market share among the new is highly predictive of long-term market share. All I have to do is not disappoint you, Kevin, and you will become that 50, 60-year-old with Lemonade. And as you go through that, you will go through predictable life cycle events, upgrade your property, add life insurance. The kids come in and you car, we spoke about the pet, whatever you need. And suddenly you'll spend $60 on insurance when you're 22, and it will jump to $600 when you're in your late 20s, early 30s. It'll be $6,000, so 100x increase, quite possibly over the 10 years that follow. And that's really our strategy. This is a very long-term strategy. I'm not worried about how do I win over the 50, 60, 70-year-old. It's how do I delight the 20, 30, 40-year-old who's already with me. One other thing just to say is, while our average age is what we said, we have plenty of older people.
Sure.
It turns out that there's the digital-first nature of Lemonade skews young, as you would imagine. But I've got a grandmother who's about to turn 98. And she uses Amazon and she uses technology and she photoshops photos and she does everything. People of all age groups are availing themselves of technology. So we do have customers up and down the age span. But yes, the concentration is exactly as you would expect it to be.
Got it. Yeah, and that's actually really exciting to hear. That you said 98 working with Photoshop. I think that's super cool. Wow, because I know plenty of even 60-year-olds who are like, Photoshop? Nah. Yeah, so that's awesome. So what about? And this is, this seems like a potentially totally different industry, but what about like health insurance itself? Is that just a totally different world, or would that even be on the radar?
Never say never, but it's not on the radar today.
Fair.
And it feels to me like, particularly in the US, health insurance has as much to do with politics as it has with insurance. So just think about the transformations in the US policy towards private health insurance and Obamacare and the Trump administration and now the Biden administration. So you're suddenly playing geopolitics as much as you're playing kind of customer-centric solutions, which is really where we prefer to be playing right now.
Gotcha. There's a question here from actually an insurance agent. They were wondering where do you mention that people, for example, are, on their home might get depreciated value on like a roof? Is that something that is upfront mentioned, or do we have to click the buttons in the chat? And so, question about disclosure, I suppose.
Yeah, our policies don't default to depreciated value. They default to paying replacement value. But yeah, we do have a full FAQ on the website. When you buy a policy, either on the website or on the app, we try with iconography and with short sentences to explain what is really covered. One of the huge problems with insurance is that the policies are inscrutable. They talk in gibberish if you're not a highly trained agent like your questioner there.
Yeah.
And we've also tried very hard to rewrite the policy. Unfortunately, in the US, for regulatory reasons, it's been hard to do. But in Europe, we use policies that are plain language, no jargon, half the length of traditional policies. We actually open source them and uploaded them to GitHub and let the community edit them and make sure that they were readable. Yeah, and we allow all of our competitors to use them. It's under an open source license. So we are trying to be innovative in terms of explainability and making stuff plain and approachable, because insurance is anything but.
Yeah, no kidding. Especially like you said here in America, it seems like every time I apply for one, there's always like a 2 or 3 page California rider too. Like, oh my gosh. Speaking of California, earthquake insurance, radar?
Done.
Done. Oh, I didn't even know that. That's amazing.
Yeah,
done.
In fact, in California specifically, you're not allowed to sell home insurance without offering earthquake insurance.
Ah. There it is. Okay.
Yeah.
Now, one of my, and this is maybe less about the company and more me, one of my things about earthquake insurance as a real estate investor has always been, well, golly, before I spend 10% of the property value and damage to get to my deductible on earthquake insurance, I can fix a lot of drywall and a lot of damage around a place. When is earthquake insurance going to be something that's a little bit more standard? Like, oh yeah, I'll get earthquake insurance on all my properties. Or is it just too expensive? Is it a loss leader?
It's been surprising to me how few people do buy it, even in earthquake zones. So
yes.
As I said, the California regulators require us to offer it. We'd be happy to offer it anyway, but it's a requirement. And the uptake of people in California who buy earthquake insurance, if memory serves, it's only like 10% of people.
Yeah.
For myself, I think earthquake insurance is the kind of insurance that you just never want to do without. If your laptop gets stolen and you don't have it insured, it's a pain, but you'll live. It's not going to be a life-altering event for you that your laptop was stolen. If your home is destroyed in an earthquake, for most people, that is something that they may never recover from. And the stuff that you cannot self-insure, that you couldn't handle if disaster strikes, that's exactly the things that you want insurance for. So earthquake insurance, life insurance, these devastating events. So I would encourage everybody to get earthquake insurance. Absolutely.
Very fair. For the artificial intelligence, the AI, how much has your machine learning really evolved over the last 4 years? Is it the same, hey, they checked the box, they didn't check the box, kind of, okay, their risk portfolio is, 51-49 kind of thing? Or is this thing becoming really much more powerful as you're scaling?
At some point, we'll hit diminishing returns. The curve kind of will asymptote a bit. But no, we're not there. We're still seeing tremendous benefits. Wow. We're young. And the relevance of that is that we have had a lot of claims, but not that we have many more customers than we have claims. And the AI is really all about finding correlates between all the different signals that you can get from a customer and claims behavior over the years. So it does take time for those fields to populate, for you not only to see, oh, he ticked the box, not ticked the box, but did that result in a claim 3 years later? We've only been in market 4 years. There's only so many of those kind of claims that we can use to train the AI. So definitely we're still seeing the feedback loops kick in, and the data is getting better and better. The AI is getting smarter and smarter, no question.
I mean, I think it's incredible. I think there was an example that actually your company put out where it was somebody was asking about insurance for, I think it was photography equipment. And then, is this specifically covered? And then like a year later, they put in a claim for stolen photography equipment. and your system somehow potentially alerted this as fraud. Was that, am I right about this example?
Yeah, so there's been a bunch. I mean, frankly, it's a daily event where the AI many times a day will kind of be scouring claims and finding stuff. So this happens all the time. Sometimes it's hard fraud, the kind of thing where people are using costumes and just, literally pretending to be other people.
What? To like steal stuff?
Yeah, we had some stories of this guy, I think, but he was wearing different wigs and different makeup and making claims under different names, and the AI picked up on that. And so the machine vision was able to see through the costumes.
Just facial recognition?
So we have the way you make a claim at Lemonade is you open up your app, it asks you a few questions, and then you hit a button and you record yourself speaking into the camera. So we pick up both visual and audio cues, and we can analyze those for consistency and oddities. That wasn't a subtle case.
Yeah. Oh my gosh.
So we're constantly seeing stuff, but I'll tell you, it goes beyond AI. What you're asking about is that there's another dimension to bring into play here, which is really interesting and I think underappreciated. We built our company from scratch with a single system that does everything that our company does. It's all in-house technology. So the marketing campaigns, on Facebook or YouTube are run by the same system that then sells you a policy, answers your questions, sends you the billing, and deals with your claim. So an instance where you did something dodgy at some other interaction, the question that you ask customer support about whether the equipment is covered, in another company, that would be handled probably by humans.
Right.
And by humans in an entirely different department, probably a different geography, running a different system. And therefore, it's entirely siloed. Claims and customer support have no connection. Marketing has no connection. At Lemonade, we've really only got one brain. It's not thousands of separate brains. It's one brain. And when you have one brain doing everything, it knows that you asked that question whenever you asked it, and that you made the claim, and that there's something strange about the congruence there and all of that. So it's really not just about AI, but about architecting something in an organic, internal, single system integrated fashion, which I think is without precedent in the field of insurance, frankly.
It seems that way. And it also seems like your insurance competitors, maybe the State Farms of the world or whatever, maybe I shouldn't mention names, but whatever. It seems like there are other, companies, or maybe it's the agents or who knows, that hear Lemonade and it's like, Lemonade, whatever. Is this just, typical industry competitiveness, kind of like in real estate where you get the real estate agents go, Redfin, whatever, until it's too late and all of a sudden you're ubiquitous?
I certainly like to think it is. In my mind's eye, this is not so much about Lemonade, but about the category of insurance. I don't want to flatter ourselves, but sure. In my mind's eye, I play a conversation that must have happened around Walmart or someone in circa 1995, 1996. And somebody comes to the boardroom and says, hey, this guy's Amazon. They're doing this cool thing. They've got a website. They're selling online. We should sell online. Right. And they say, okay, hey, John, HTML. Can you do a website for us to sell online and something? And they go off and they create their website. And what they fail to understand, because all they see is the facade, Amazon's a website, we can do a website. What they fail to understand is that Amazon built itself on an entirely different building blocks, entirely different culture. They are a tech company. For them, technology is not a cost center. It's the very platform, the very chassis, the substrate upon which the whole company was built. And therefore, the first differences that you see, they have a website, we don't, is just the outermost expression of a profoundly, deeply different culture. And those differences that at first appear superficial manifest in ways that become more and more and more powerful. And you think, John, you build a website and we'll close the gap. And you wake up 20 years later and you realize that the gap has just got bigger and bigger and bigger and bigger because they're spinning at different cycles, they're doing different stuff. We build, we do production builds. We push new code into the world 20 to 30 times a day.
Oh my gosh.
I think if you ask those people who are saying, Lemonade, whatever, when's the last time their company pushed out a build? It would be measured in months or quarters, if not longer than that. So if we're spinning that fast, 20 to 30 production builds a day, and they're doing 4 or 5 a year, you tell me, is this gap gonna converge and close, or is it just gonna be more and more and more pronounced over time?
Is that then similar to almost like Tesla versus, say, the legacy automakers, where the legacy automakers are still stuck with the internal combustion engine assembly lines and sort of that mentality? How do they transition compared to how quickly you might be able to transition like Tesla?
I think the metaphor does hold. And again, I don't mean to flatter us.
Sure.
Tesla's an extraordinary, incredible company. I wish that one day we're worthy of that comparison. But elements of it do ring true to me. I've had a lot of time that I've been able to spend with incumbent insurance companies, with those large insurance companies, and actually got pretty friendly with several of their CEOs, some of whom invested in Lemonade.
Oh, wow.
And they are smart people. They see the writing of the wall. One of them, CEO of one of the largest insurance companies in the world, said to me, "I fancy your chances more than I fancy my own."
Now you got to tell us who it is.
Yeah. And he was talking about how, he's the CEO of this incredible company, and they just announced record results and all of that kind of stuff. But he saw the writing on the wall. He saw that he's got 100,000 employees who are moving at a pace that he just can't affect. He's got a board of directors that is made up of investors who just want 5% dividends and don't confuse us with bold things. So he doesn't get board support for bold moves. He doesn't get team support for bold moves. The culture is one of legacy preservation, not business transformation. He's got all these systems dating back. He said to me, we spend $3 billion a year on IT. $3 billion a year, which is a stunning amount of money, and they have nothing to show for it. It is standing still, spaghetti code that dates back to the 80s, COBOL, all systems that don't work. And it's just, I said to him, we're building a black box. You've built sorry, I said to him, we built a black box. You've built a black hole. You just pour stuff into it. And that's really true. And he's smart and he knows exactly what he's doing, but it's just the innovator's dilemma. And I'm sure that General Motors and all of the car makers, I'm sure they're led by smart people who wish they didn't have 100 years of legacy, cultural legacy, technology legacy, business architecture that they just wouldn't build that way today, but they do. And they're stuck with that legacy. And that's just a problem. If you really think about, this is true of Tesla, it's true of Lemonade, so much has changed in the world in the 21st century. It's just transformed. It's one of those once in an eon transformation. We hear about the Middle Ages or the Industrial Revolution, or go back to the farming and domestication of plants. It's one of those huge transformations for humankind that there is a before and after, and you can't compare them. The whole digital transformation, and companies that were established before that hit were just not built for this era, and they're in catch-up mode, and they're dealing with legacy that they wish they didn't have, and it's not their fault, and they're led by smart people, but they are wrong-footed going into the 21st century.
Wow. I mean, that's something that that was such an incredible explanation, first of all, on the impact of really just being a legacy business. And that applies to so many different industries. And it's hard to, as you were describing that, I was picturing in my head, well, golly, everybody's probably in these offices with computers and these old servers, and even just down to the old wiring, like everything's old. It's like a 1960s building still, right? as opposed to you being able to essentially start new in that metaphor. And I think that's such a great example, and innovator's dilemma. Thank you for saying that. To me, a little bit, and just to make one more comparison that I want to ask you about is that kind of like, so you had mentioned Walmart versus Amazon. I think of Target a little bit in that sense. And Target, I love Target. But one of the problems I hear when I listen to their earnings calls is they have employees that when somebody orders stuff online, they have employees who stock the shelves at Target. Then somebody orders something online. Then they got to send an employee to take it off the shelf and package it up, as opposed to what Amazon does.
Yeah. And you remember Blockbuster tried to compete with Netflix, it still existed, by having the staff in the Blockbuster store stuff envelopes with DVDs and mail them out. But you're exactly right. And Target and Walmart are the winners among the retail legacy. So many others have gone out of business, right? So they're the ones who actually have managed to adapt enough to stay alive. Whereas so many
Adapt enough.
really, you
Wow.
know, I give you a colorful story, a true story. So I met some guy who was doing IT work for a large insurance carrier, and he was bemoaning the difficulties. And he spoke about how he said the way they code all their customers is they have the same number of bytes as a punch card, because they transitioned 50 years ago from punch cards, so they're still limited by the punch card architecture. And one of the fields in the punch card is still taken up by whether or not the person involved is a vet from the Civil War.
What?
Yeah, these people carry forward so much. Anyway, he was there doing a Salesforce.com integration for these. And I said, oh, that shouldn't be a big deal. He said it took him 2 years to do something that should have taken 2 weeks. I said, why was that so difficult? And he says to me, well, I had to integrate with JPL. And I was like, sorry, what's JPL?
Yeah.
He says, oh, you wouldn't know. He said, it's Jim's programming language. So this insurance carrier, in the 70s, they built some tech. They hired a guy called Jim, and Jim used his own programming language. And he promptly died. And his legacy lives on. They still have to worry about JPL, Jim's programming language. So you just think about that. If you're carrying stuff forward from the Civil War and from Jim's programming language, you are just so deeply disadvantaged. It's almost unfair.
Gee, my goodness. And one of the things I've looked at for your company too is just the thought that you are really building new. You're attracting the millennials, and over time, and you've mentioned this, they get into the other verticals. I mean, realistically, the millennial generation right now, they're not the biggest real estate owners. I feel like we're probably more heavy into delaying real estate ownership, even delaying marriage these days, and children. Everything's just getting delayed. To me, it just makes me feel like maybe you're just a little bit of a hidden gem that maybe it'll take 20 years to blossom fully, right? As people age and continue to add these other products. Is that a wrong way to look at it? Is it, is that really the goal, to just grow with your customer?
Not just, but yes, it really is. So any tech company that you look at, when they talk about lifetime value of a customer, incredible companies. Think about investing in Peloton.
Yes.
So you do find yourself wondering, or Netflix, or other kind of companies, you do find yourself wondering, will people still be doing it this way in 3 years' time? So yeah, people like riding bikes, whatever. Is this a fashion, or is this a fad, or is this going to survive for the long term? And you have to take that into account when you're considering the lifetime value and the economics of the business. You have to think about, how long can I really assume that somebody's going to keep doing this for? Insurance is the most extraordinary space, because when a 22-year-old joins us and buys a policy, I can tell you to a near certainty that they will be paying insurance premiums for the rest of their life. When I talk about lifetime value, it is lifetime value. They're going to be paying premiums in their 30s and 40s and 50s and 60s until their dying day. And I can tell you more than that their premiums for the first 30 years are going to go up a steep curve. Just because life happens, it's good. Their personal GDP grows. They move from a rental with a roommate to a rental on their own, to their first there, to there, and then the family and the house in the suburbs, and they go through these things. We tend to accumulate stuff during the course of our lifetime. It's just... Yeah. And it's as good, it's both people that we care about and pets that we care about and property that we care about. And all of that reflects itself in insurance. So yes, I think that thinking of acquiring customers young and thinking about them as a gift that keeps on giving, so long as you treat them with respect and serve them well, they will be paying insurance premiums for decades in ever-growing rates, and not growing by 10%. I mentioned Netflix. I upgraded my Netflix recently to another couple of screens. So I pay them 10% more. When you upgrade Spotify, you pay 10% more. When you upgrade Lemonade, you pay 10x more. You go up by hundreds or thousands of percent. It's extraordinary. So I guess my answer to your question is yes, you should think about us as building a valuable cohort. We have over 1 million customers now. And those cohorts, if we treat them well, will grow, and it is a long-term prospect Don't measure that in a quarter or two. Do think about this as building a generational company. How to become a company that survives for a very long time, and insurance companies do. Insurance companies can survive for hundreds of years. So it's definitely a prize worth fighting for and taking your time and thinking, playing the long game for. Absolutely.
So would you then describe this, accumulation of potential revenue per customer as more of an exponential style S curve rather than linear, or how would you paint it?
Yeah, the funny, another kind of curiosity about insurance is just how big the market is.
Right.
We announced that at the end of the year, we had slightly over $200 million of premium. And we're growing at almost 100% year on year. So you think about this kind of doublings, and we're, 2 or 3 doublings, you'll see us 10x that, and you get to $2 billion, and another few doublings, we could get to $20 billion. And at that point would be one of America's smaller insurance companies.
Oh my gosh. Okay.
And if we doubled another few times and we made it to $100 billion, then we would have about 4% global market share.
Wow.
So this is a market that at first approximation is as close to unlimited as matters. It's just that big. It's stunning in its size. So I do think that rapid growth could be with us for a long time. Everything at the end, every exponential growth curve at the end meets the S.
Right.
But I think we're a long way from seeing any significant slowdown in growth.
Nice. Oh, I like that. The talk about these legacy, companies versus how you've kind of started from scratch. Is that a problem for GameStop?
You have to elaborate on that one.
Well, GameStop says they want to transition to online e-commerce, and Ryan Cohen's Chewy co-founder is going to come in and transform them. Everybody's excited about GameStop right now and GameStop stock. I mean, kind of what you described sounds like a potential problem. I mean, how hard would it be for a legacy business to transition? And, what kind of commentary would you have on that?
Well, I'd challenge you here and now or in your free time to name 5 companies in the history of the world from any sector that you care to mention who were large, successful incumbents and were able to transition.
Wow.
5.
Well, I'm going to have to circle back on that one. I think you nailed me there. That is a very good hypothetical question. Yeah. Golly. I mean, geez. I mean, you think of like the General Electrics, right? And I don't know that they have that appeal today like they used to. I mean, even one of the issues you had at Microsoft was once they started growing, you started getting this fragmentation within the company, and then the company was almost competing amongst itself rather than together anymore.
So I think GE is an interesting one. Back in the day, Jack Welch, he did it. I think he's one of the legitimate 5 examples that I would accept. Although they weren't able to sustain that.
Right.
People go to IBM, but IBM was at a near-death experience. It's not clever to turn around when you can't make payroll. That's a restart. But companies that are doing reasonably well. I had this conversation with that same CEO of a large insurance carrier that said to me, that he's worried about the future.
Yes.
And then he told me I said, well, what are you going to do about it? And he gave me all these, frankly, platitudes. Oh, we're going to set up an investment arm. We're going to create a little innovation team. All these things that large companies say they're going to do. Yes. And I challenged him and I said to him, can you name 5 companies that ever reached your size and were able to do that? And he named GE and then he stopped. And it was, been around this. It's genuinely difficult, and it's no fault of the leadership. It's just really, if you think about the structural challenges of taking a company that was businesses have architecture, businesses have culture, they have values. And if those are misfits, given the reality of the world, that is tough. That is just really tough to do.
It's interesting. I don't know how I feel about having mentioned the same company as him with the GE. But okay. What about golly, this is fascinating. Thank you for that. What about the fact that a lot of people complain that insurance is low margin, that this is an old industry and it's hyper competitive and you can't cut out a profit here?
I haven't heard too many people. Not too many people have asked me that question. So I don't know how prevalent that perception is. But let's
Okay.
take it apart.
Sure.
Insurance carriers in general have been profitable for forever. So there's a reason why Berkshire Hathaway is majority insurance carriers, and what they do, and they've used that as a float to make all their investments. And Warren Buffett understands insurance profoundly and likes it as a building block for his empire.
Yeah.
And other insurance, the Liberty Mutuals that you mentioned and others of this world have done just fine over the last 100 years. How many other industries can you name where all the companies that dominate have survived a century or two or three? So they're obviously making enough money to keep the lights on.
Yeah, true.
In our company in particular, so we see gross margins in the low 20s, which I think is really very, very good. That's unusually good. So we do see strong gross margins. Now, we do expect SaaS companies to be making 90% gross margins. Oh, what's 20? But if you think about a lot of companies where there's a real cost of goods, so not Google or Facebook, but Amazon for a long time had gross margins in the 20s. Spotify, that has to really pay for the songs that they get, had gross margins in the 20s. I think they've climbed into the 30s. And Netflix, same thing. They've got a real product that they have to resell. So a lot of subscription businesses like Spotify and Netflix that have created a stunning subscription-based tech and profile that has some similarities to ours, in that the same kind of price points for same kind of consumers, same digital experience, have made very, very successful long-term brands and businesses with gross margins in the 20 and 30s, not in the 90s. So SaaS is not the only way to go.
Right. Okay. So not only Snowflake. Gotcha. So, okay, what about cryptos and non-fungible tokens? When can I insure my digital artwork with you?
It's not a high priority right now. It is a fascinating area. The whole DeFi area is fascinating, and we continuously kind of look at what is its applicability to what we're doing. We haven't seen a transformative use of those kind of technologies, the crypto, the Ethereums. We haven't seen a transformative application for it in what we're doing yet. We'll keep monitoring the space and keep seeing if there's something exciting that we can do in this space. And insuring NFTs, you start off by asking me about cars. There's still more prevalent problems out there than how to insure 5,000 images that have been converted into one.
It's worth 69 million. I mean, come on, give me a nice premium.
Somebody should insure it. We don't insure Picassos today either. We don't insure. We really are a product for the masses, not for the people who can afford $69 million pieces of art, whether they're NFTs or hanging on a wall.
Right. Okay, fair. That brings up a question from one of my group members. They mentioned they applied for Lemonade, and they integrated photography equipment, but then there was a claim, and because it was deemed business related, that portion of their claim was excluded. Is that common? Is there potentially was there a branding potential issue there? Or can you speak to that a little bit?
Yeah, and this is something that we hope to tackle in the fullness of time. But we spoke earlier about how regulated this industry is, and how set more or less in stone the policy language is, and how difficult it is to get regulators to approve alternative ways of framing insurance coverages, etc. So we are determined to take a run at this in the fullness of time, but we just haven't got there yet. So today there's a fairly bright line between personal lines, when you're insuring stuff for personal use, and business use. And the policies that we sell today are for personal use, and they do explicitly exclude professional equipment for professional usage. As I said earlier, we want to cater to all of our customers' needs, and we recognize that the nature of work is shifting, right? So you've got the gig, other kind of modes of work where those bright lines between professional and personal are really merging. You use your laptop to chat with your friends, and then you design websites for Shopify or Wix or whatever in your spare time, or you go onto on Fiverr, you offer your services. And what was once a bright line between personal use, or you have a camera, you do wedding photography in the evenings, and you use it for other things during the daytime. So we do try to communicate that as clearly as we can. Sometimes people buy a policy and they don't see everything, and we do then encounter instances like the questioners. And I'm sorry, we hope to be able to cover these kinds of situations as well. We keep adding more and more coverages. We'll get to that one as well.
Got it. So maybe that business risk or business property might be something that comes in the future, huh?
Yeah, and it ties into your question about rental properties. In general, people who own stuff that they use for non-personal, whether it's a home or a camera or a laptop, is something that we haven't fully cracked yet, but it's on our drawing board.
It's coming. Awesome. Talk to me about whole versus term. And I spoke with the CEO of Ladder Life last week. And they mentioned that first of all, they had nothing but good things to say about y'all. They did draw a distinction between your model and theirs in that they say they've written their term from the ground up, and that maybe you're brokering your term. I'll let you take over now.
Sure. So Ladder Life is incredible. I've got only good things to say about them. And if you had a chance to speak to Jamie, he's just such a stand-up guy and so articulate and passionate about life insurance in particular. And he's got a personal story about how his own family was saved by life insurance. So it's very moving to hear him talk about this. And he talks about this with greater authority than I bring. So he's really been deep in this for many years. So I'm sure whatever he said is right and whatever I say will be less right.
Oh, wow.
And they did transform, I think, fairly recently, or I could be wrong on the details, but they started the first several years of their life, they also brokered their life insurance. So they bought a life insurance carrier fairly recently. And we're starting the same way in life, because the insurance carriers that we built, again, it's the same regulatory stuff that we spoke about, are only allowed to write P&C, property and casualty insurance. They're actually not allowed to write their own life insurance policies quite yet. So today you get the full Lemonade experience. You should give it a try. You go to our app, you go to our website. It's fun questions. You're done. You get a policy, 0 visiting doctors, no fluids to give to anybody. It's all very simple and straightforward. But it is true that the plumbing behind the scenes, we do work with a third party to carry the risk there, because from regulatory reasons, we can't do that ourselves quite yet.
Gotcha. And is whole something you would even consider looking into in the future?
Not a high priority. I think for our customer base, term life makes a lot more sense than whole.
And what about micro insurance briefly? I mean, there's talk about, these $1, $2 premiums, or, paying per mile, things like, is that even on the radar?
We've been watching that with interest for the last 5 years, because a lot of people have been advocating for that. We don't get it. We're open to it. And if customers want it, we'd give it to them. I don't think customers do. I think customers don't want to think about insurance.
Yeah.
They want to get what they need and leave me alone. And I don't want to have to, I'm going skiing now, so let me cover my skis. I'm taking my camera out. So I'm going to turn on my camera. I think from an actuarial point of view, it doesn't make much sense, because the premiums that you pay me today for your skis for the whole year are really there for the time that you take them out anyway. So I'd have to charge you almost a whole year's worth for when you actually use the stuff. So I think from an actuarial point of view, it's a bit of a misnomer, more of a marketing trick. And if you're really customer centric, you don't want to be driving your customers mad with turning things on and off. You want them to have peace of mind. I bought the thing, leave me alone now. I want you to be there for me if something bad happens, as opposed to making this a high intent, not only purchase, but then activation. So I'm not bought into the thesis, but we'll keep monitoring it.
Last question, because I know you've got to run. And I don't know if you can touch on this one, but I've got to ask, because it was brought up quite a few times. After Motley Fool had their run, which they had some wonderful things to say about y'all, you did sell some shares on January 21st, I think. Can you speak to that a little? Yeah.
So there's a couple of things I'd say. One is I see some of the chatter about my sale of my shares. I own a lot of my shares are held through a holding company. and that can be misleading. I see some people tweet, oh, he sold 95% of his shares. No, no, no. I sold a very small fraction of my shares. I hold the overwhelming majority of my shares, and indeed the overwhelming majority of my net worth remains in Lemonade stock, and I think will for the foreseeable future. I'm incredibly long on Lemonade. At the same time, it does make sense to divest partially and to have some of that wealth invested in other vehicles. So I did, what is minimally sensible, kind of responsible thing to do. But I am incredibly invested in Lemonade, both myself and my co-founder. The overwhelming majority of our wealth is in a single stock, and that stock is LMND. The other thing I'll say is that almost all the insider sales that happened, including most of the sales that I have done, are triggered by something called a 10b5-1 plan. So what happens is, in order to avoid even the appearance of insider trading, you never want to be trading because you knew something that other people didn't know. What it's done, there's a rule of the SEC, it's rule 10b5-1, I think. Yeah. And what that says is that you put together a plan, which is an arm's length algorithm. You write a plan, and then there's a 30-day cooling period where you mustn't touch it. And then after the next earnings report, it goes into effect. So you've got a real distance. You couldn't know anything that wasn't known to the public. And you just put in rules there that, okay, sell this many shares at this, and it could last a year. You might think, oh, it's going to take 5 years to execute this plan. Yeah. After the Motley Fool recommended the stock, and it had a run, we IPO at 29, and then it hit 180. So for a lot of insiders, stuff that they didn't plan to sell got sold because it triggered different parts of that algorithm.
So they're price triggers.
They're price triggers. So what happens is you might think, oh, it's going to take us 3 years to get there, and you're not under any urgency. But suddenly you see all of those trades happen in a very short time. And a lot of insiders were, so to the outsider looking in, it looks, oh, they know something, they sold a lot of their stock. But no, what often happens is just a run up in a stock will pass trigger points in 10b5 plans. And then you see concentrated sales just as a byproduct, an artifact of the way those plans are built. And it's not a signal, it's noise. And everybody around the table, around the board, myself, my co-founder, are heavily, heavily invested in Lemonade. Fear not.
Well, what a wonderful way to end it on. Thank you so very much for your time. Look forward to maybe in the future having another conversation. This was so insightful, very, very bullish on your company. So it has been an honor. Anything else you want to leave off with?
Thank you, Kevin. I'd love to come back.
Awesome. Well, stand by for one moment. Everybody watching, thank you so very much for being here. If you found this helpful, consider liking and sharing the video. And folks, we'll see you in the next one.